Understanding issuers in the financial market. In the world of finance, the term issuer plays a crucial role in the process of capital formation. An issuer is a legal entity involved in the development, registration, and sale of securities, such as stocks and bonds, to raise funds necessary for its operations. Understanding the concept of issuers is fundamental for anyone interested in investing or analyzing financial markets. What is an issuer? An issuer can be any legal entity that creates and sells securities to raise capital for various purposes. These entities can include 1. Corporations. Large companies often issue stocks and bonds to finance operations, acquisitions, or expansions. Publicly traded companies are required to disclose extensive financial information to regulators like the Securities and Exchange Commission, SEC. 2. Investment trusts. These entities pool money from investors to invest in a diversified portfolio of assets. They issue shares that represent an investor's ownership in the trust. 3. Government entities. Both domestic and foreign governments issue securities to finance public expenditures. Government bonds, for instance, are a common way for governments to raise funds for infrastructure and social programs. Legal responsibilities of issuers. Issuers bear a significant legal responsibility. They must adhere to specific regulations governing their jurisdiction, ensuring transparency in their financial conditions, material developments, and operational activities. This means regular reporting and disclosure of financial health and corporate actions that might impact investors. Types of securities issued. Issuers provide various types of securities, primarily including common stocks, represents ownership in a corporation, entitling holders to vote at shareholder meetings and receive dividends. Preferred stocks. These investors receive dividends before common shareholders and have a priority claim on assets in the event of liquidation. Bonds, a fixed income instrument representing a loan made by an investor to a borrower, issuer. Bonds typically have a defined term and pay periodic interest to the bondholder. Notes and debentures, similar to bonds but often come with a shorter maturity date. Debentures are unsecured bonds backed only by the issuer's creditworthiness. Mutual funds and ETFs. These pooled investment vehicles aggregate funds from multiple investors to invest in a diversified portfolio of securities. The role of issuers, a case study. Consider ABC Corporation, which decides to sell common shares to the public. The capital generated from these shares enables the corporation to fund its operations, expand its market presence, or innovate its product line. As the issuer, ABC Corporation is obligated to file reports with the SEC disclosing its financial health, operational developments, and any risks that may impact its success. Compliance with legal standards is a critical part of being an issuer. Non-issuer transactions. A distinction exists between issuer transactions and non-issuer transactions. A non-issuer transaction refers to the sale or purchase of securities that does not bring any benefits to the issuer. This might involve stock trading between investors in a secondary market where the initial issuer does not receive any funds directly from these trades. Issuers versus investors. While the issuer produces and sells securities, investors are the individuals or entities that buy them. In many cases, the investor acts as a lender to the issuer, providing capital with expectations of returns through dividends, for stocks, or interest, for bonds. Investors must perform due diligence on the issuer's creditworthiness to assess the risk of default, the possibility that the issuer may not meet its obligations. Credit ratings of issuers. Credit ratings are crucial metrics that help investors evaluate the risk associated with various issuers. Rating agencies like Standard & Poor's and Moody's assign letter grades to issuers of debt securities reflecting their creditworthiness. AAA, highest quality, low risk of default. BB and below, considered junk bonds, indicating higher risks. D, represents entities in default. Countries, too, receive credit ratings. These can fluctuate based on economic reforms or crises. For instance, Greece's credit rating plummeted to CCC+ during its financial turmoil but improved to B after successful reforms aimed at economic recovery. Conclusion. An issuer is a cornerstone of the financial ecosystem, driving capital formation through the issuance of various securities. Understanding the roles, responsibilities, and risks associated with issuers empowers investors to make informed decisions. By evaluating credit ratings and the context in which issuers operate, investors can better navigate the complexities of the financial markets and capitalize on opportunities while managing their risks.